Alright, for this video I want to go over a sample form 5227 for a split interest trust, and specifically this is going to be a charitable remainder unitrust. So there's a lot of different types of split interest trusts. I'll have several other videos covering those other types of scenarios, but in this example we want to focus on a charitable remainder unitrust, or a CRUT, C-R-U-T for short. So we've got the sample 5227, which we'll go through in more detail. I do have a sample 1099 issued from the broker for the brokerage account that's set up for this trust. And then we also have just a sample set of financial statements, kept it really simple here, showing the income and expenses and some of those balances at the end of the year for the balance sheet. And then another more detailed income reconciliation and how we calculate our unitrust payment for the current period. And then lastly, just two slides here covering some background on CRTs, and then the fact pattern that we're going to be working with, and some more of the details on the 5227 itself. So if we start with the slides here, and then I'll get into the financial statements, and then we'll start going through the 5227. So when we talk about the split interest trust, we're really thinking about two different kind of baskets, right? So we have charitable lead trusts and then charitable remainder trusts, or CRTs. And then within the CRT community, we have annuity trusts, or CRUTs for short, and then the unitrust family. And then if we go down further even into the rabbit hole here, the charitable remainder unitrust basket, the CRUTs, also have additional characterizations within that. So we have net income CRUTs, we have net income CRUTs with makeup provisions, flip CRTs, and the like. So this scenario isn't going to apply to the net income CRUTs with makeup provisions. I'll have separate videos that cover those, so check out the description below. But the one we're talking about here is, again, more specifically the kind of standard CRUT or charitable remainder unitrust. So split interest trust, right? When we talk about split interest trust, it's a split interest trust because we have both charitable and non-charitable interests, right? CRT, in this case, a remainder trust, provides an annual payment of income to a non-charitable beneficiary, so an individual taxpayer, let's say, for either life or a term of years. And then at the end of that period, there's a charity that's going to get the remainder of the assets, right? So that's how a split interest charitable remainder trust works. Now, CRUTs versus charitable remainder annuity trust, CRUTs use a fixed percentage times the fair market value of those net assets, and that's valued annually. So the unitrust payment, and this is a Treasury regulation here, right? It has to be at least 5%, but no more than 50% of those assets. Now, the unitrust dollar amount that actually goes to the beneficiary, that's generally going to go up or down from year to year. And that's because the percentage is staying the same, but as you revalue the assets every year, right, because the amount of income earned, the expenses, what are the carrying value of those assets, those are going to go up and down. So the actual dollar amount that the non-charitable beneficiary is going to get is going to change from year to year, right? It might stay relatively the same, but very rarely is it going to be exactly the same. Now, what's really important to remember about CRTs is they are exempt from federal income tax unless they have UBI. And so in this example, we're doing just the 5227. We don't have to do a 1041. So in contrast, when we look at lead trusts, charitable lead trusts are not exempt from tax. So not only are they doing a 5227, but they also have to do a 1041 to calculate and pay any federal income taxes that might be due. All right, so let's look at the fact pattern here, and then we'll start looking at the return in those financials. So this is going to be a CRUT that was set up in February 2022. John Smith funds it with $1 million in cash. Now, the trust agreement says that it's going to pay a unitrust amount equal to 6% of the net FMV of the assets valued as of the first day of each tax year. The unitrust period shall be 10 years, and then the amount should be paid in equal quarterly installments at the end of each calendar quarter throughout the year. So John sets up this trust. The non-charitable beneficiary is going to be his son, Adam. And then the remainder, that charitable group, that's the remainder beneficiary here, is going to be a Florida-based medical charity group that is a 501c3 organization. Now, once the $1 million is put into the trust, it's then invested into some publicly traded stocks. And so during the first year, the total unitrust payment is going to be $54,082 to Adam. Now, the unitrust payment in the agreement says, well, you should calculate it using 6% times, what's the value of the assets at the start of the year. But because this is a short year, you can prorate it. So for the first year and then the last year, you are allowed to prorate the unitrust amount. So that's why we don't pay Adam $60,000 for the first year. We pay him this reduced prorated amount of $54,082, and we'll look at that in more detail when we get to the Excel workbook. And then as far as expenses and income, total expenses were $3,200, and then gross investment income earned within the trust was $68,465, which when we look at the 1099, we'll see it's a variety of different types of income: interest, dividends, capital gains. All right, so what parts are we going to be completing here? CRTs, again, they are exempt from federal income taxes, so we don't have to do the 1041. Right now, the 5227 is very comprehensive, right? So there's going to be a lot of parts that will apply to net income CRUTs or net income CRUTs with the remainders, or just regular CRUTs, lead trusts. And we'll see this when we go through the parts, is there are going to be sections that you are basically just going to omit because we just have a type of trust that part does not apply to. Now, the 5227, the income beneficiary here, that's the non-charitable beneficiary, needs to get a K1, right? And the K1 is going to show, okay, you were paid a certain amount of cash or property, and to what extent does that constitute income, and what kind of parts? And so we'll see that when we look at the 5227 K1. When Adam gets his payment, he needs to know, okay, well, this is going to be income to me, but how much and what's the character? Also really important to remember are the self-dealing rules. So CRUTs have to apply a lot of the private foundation kind of self-dealing rules, and so we'll talk about that in a little more detail as well. And then the unitrust payment amount, again, this is character of income is so important here, right? When you distribute cash or property to the non-charitable beneficiary, there are certain ordering rules which you have to apply based on the income that was earned within the trust. And so when we look at the workbook and the return, that'll hopefully make a little more sense. But very important to follow those ordering rules to make sure that the income beneficiary is accurately reporting their taxable income on their return. All right. Okay, so let's have a look at the return and then the workbook. So we put together just a very straightforward kind of profit and loss and a balance sheet for the trust. So we have the interest income earned over here, the dividends, the capital gains on the stock, and then the expenses. And we've pulled these numbers from the 1099 that the trust receives. So the trust, again, it took that $1 million and it opened a brokerage account. And so it might look something like this for yourself as well. You'll have a 1099 issued to the trust under the trust EIN. And so it'll comprise a couple of different items. You might have more or less, but we have dividend income, interest income. They got some short-term capital gains transactions here. So all of that will get reported as well. And then the expenses were paid out of a separate account, right? So we might have to, the broker isn't going to have these expenses, right? The broker is going to have the kind of investment activity, but the expenses you'll have to provide separately as well. And then on the asset, liability, and equity section, we have the carrying value for the bank accounts, right? What's the cost basis in our investments? And then we do track the fair market values. And that is really, really important because we have a unitrust. We are calculating the unitrust payment based on the fair market values as of a certain date. So at the start of the year, we didn't have any stocks yet. We only had cash, so we've got $1 million in the checking account. And then we have our fair market values here at the end of the period, right? So very, very important to be mindful of these values. All right, so let's have a look at the tax return, and we'll start going through some of these pieces. So the name of the trust goes at the top, right? If this is a short period return or a fiscal year return, you would input the dates that the start of the year, the end of the year, because you don't have a full calendar year 2022. So our trust was funded on February 5th, 2022, so that's why we've indicated as such here. So we have the EIN, the name of the trust company, contact address, and then in box C, the type of entity, we have a Charitable Remainder Unitrust as laid out in section 664D2, right? So if you had a lead trust, you would hit box 1. If you have a CRUT, you would do box 2. If you have a net income CRUT or a net income CRUT with a makeup provision, you can still check box 3. You just have to complete different parts within the form that cover those additional elements. We do have an initial year return here, and then the fair market value of the assets at the end of the year, right? We've inputted $1,078,593 as per our balance sheet. And then the date the trust was created. So this is an initial year return. So the date our trust was created and funded matches the start of our short period year. Okay, so in part 1, we have the income information, and then we have the deductions, and then in section E, we allocate those deductions across the various income categories. And so we'll talk about this in greater detail later as well, but this section only applies to 664 trusts. So those are charitable remainder trusts. If you have a lead trust, you don't allocate the deductions in section E, you would just leave that blank. But we start with section A here, right? We have the interest income, we have our ordinary dividend income, the portion of which is qualified, right? And so we're pulling those numbers from our 1099. Then we have the short-term capital gains or loss. So we did complete an 8949 for the sale of that stock, and so as well did a Schedule D. And then once you do those, the numbers flow up here to section B for the capital gains or losses, right? We don't have any non-taxable income, so that would be things like municipal bond interest, right? So if you invested in municipal bonds, they're exempt from federal income taxes, but they might be taxable at the state level. We don't have any of that type of income. And then in section D, the deductions. So we had trustee fees, attorney and accounting fees, and so the total fees or deductions that we had in the trust were $3,200. Now, how do we determine how these deductions are allocated across the income categories? So in section A, we have our ordinary income amounts, right? $39,363. Section B, we have our capital gain income, and then in section C, we have our non-taxable income. The deductions you see here in section D should be allocated pro rata across those income groups. That's generally how it's done. There are some exceptions where you can specifically allocate deductions. So if you had a deduction here that you could directly trace to a type of income earned up here in one of these sections, then you can go ahead and allocate it specifically to that one. But in most cases, that's really not going to be the case, right? You can't necessarily say that, well, the trustee fees, the $1,200, we want to allocate that all to ordinary income, none to capital gains. It's like, okay, well, if you're doing that, why? How did you come up with that kind of allocation? And in most cases, you're not going to be able to do that. And so that's why you generally just prorate those deductions across the income. And so we have in our workbook here just a very simple summary of the total income amounts here that I have in this column, right? So we have our interest, the non-qualified dividends, qualified dividends, and capital gains. And then these are the deductions, right? So this is $3,200, and it's being allocated across each income category, again, pro rata. So we've got our formula in there where we take the amount of income in this bucket over the total and then multiply it by the $3,200, and then so that's how we allocate the deductions to each group. Now, once the deductions are allocated, then we can enter these totals onto page 1 of the return here, right? So in section E, we've got the $1,840 allocated to the ordinary income basket, and then the $1,360 allocated to the capital gain basket, right? So there's our 1840 ordinary income, 1360 capital gain. And so the net amounts of income that are going to be available for distribution to the beneficiary are these totals, right? So that's how we figure out that page 1, section E calculation. All right, so once that's done, then you can move on to page 2. So in page 2, we start to track our schedule of distributable income. So in this case, we don't have any prior year activity because the trust was formed this year. So we're not going to have any undistributed income from prior tax years. If this is a second year return or so on, you could very likely have some undistributed income. In some cases, you might not, right? If you distribute all the income out to beneficiaries, then there is no carryover. Now, what are the different columns, excluded versus accumulated NII post-2012? The excluded income would occur if you had a trust formed before 2012, and it's excluded from the net income tax. So the net investment income tax, right, that 3.8% tax, that only applies to the income earned post the enactment of the legislation. So if this is a 2022 or 2023 trust, everything is going to be post 2012. So you're not going to have any income that's excluded from that net investment income tax. And so that's why in our cases here, everything just falls into the accumulated NII post 2012 bucket, because we're not going to have any income from prior years as excluded from NIT. All right, so the numbers in these columns are pulling from page 1, right, in section E. So it's asking us here in column A, enter the amount from part 1, line 24B, right? And so that's what we've done here. Part 1, line 24B is the $37,523. And then the same goes for the capital gain basket. Now in part 3, distributions for charitable purposes, we haven't set aside any income. We haven't distributed anything yet for charitable purposes because this is a CRT, right? This is a remainder trust. The only things that we've distributed are payments, Unitrust payments to the income beneficiary. So we can leave these parts blank unless you actually had some distributions to a charitable beneficiary. Now the balance sheet in part 4, this is very, very important. You want to complete this with as much detail as possible. So, for example, in section or lines 8A, B, and C here, notice how it asks us to attach a statement. So you should put the values of those investments, right? Corporate stocks versus corporate bonds. If you have any U.S. or state bond obligations, right, you would list those there. And then attach a statement listing specifically each one. So if we look at our supporting statements section here, okay, so this is the attachment that we've provided, and we've indicated, well, we have a $832,000 investment in an index fund, and we've listed it at cost. So you don't want to just group all publicly traded securities, all bonds. You should specifically identify each investment you have. Although it can be quite time-consuming to enter each one, that's the way it should be presented, right? You want to provide as much detail as possible. Okay, so we have our end-of-year values here, $1,050 in the cash, non-interest-bearing savings account, stocks and bonds. Beginning year book value, because this is a first-year return, we're not going to have any beginning year values, right? If this is a second-year return, you'll have carryover amounts, and you can list the end-of-year amounts from last year here in column A, but in our case, we don't have anything in column A. And then column C here, for the fair market value, this should be the fair market value on that date that you're using to value the Unitrust amount, right? So what we mean by that is, okay, generally this is going to be the start of the tax year, right? So in our case, right, we put that $1 million in, and so $1 million is the fair market value at the start of the year, and so we're going to use that as the figure to value the Unitrust, to calculate the Unitrust payment amount. And so this amount, you'll see that this will reconcile with a later part in the calculation where we go down to part 6 and we actually compute the CRUT Unitrust payment amount that's going to be made to the income beneficiary. But before we jump down to part 6, in the net assets section, just want to touch on this. So the generally the trust agreement will say that if not all the income is distributed to the beneficiary, anything extra is just added to principal. But in the net asset section, for these purposes, you do have to kind of separate undistributed amounts because they carry over to future tax years. So this will make a little bit more sense when we get to that section of the return, but we can see here that while we've added amounts to principal, we didn't distribute all of the income to the income beneficiary, so we have some undistributed capital gains, which we'll see where this number comes from later on in the return. But just kind of keep this reconciliation in mind as we get to it. So in Part 5, we don't have an annuity trust, so because this is not a CRUT, we're basically not answering this section, so Part 5 could be blank. Part 6, we do have a CRUT, right? We've got a CRUT here. So we've got to complete Part 6. So question 1, it's asking us, is this a CRUT, a net income CRUT? Right? In our case, no. We don't have, this is a standard CRUT where the Unitrust percentage is computed on the fair market value of the assets, irrespective of the accounting income of the trust. So we've indicated no, we don't have a net income CRUT, and then it further asks us, do we have a net income CRUT with a makeup provision, right? So net income CRUT with a makeup provision is basically a net income CRUT that says, all right, if you have a net income limitations in a prior year, you can kind of carry over that difference, and so the beneficiary can get a little more a greater distribution if the trust makes more money in a future year. Again, not going to go into too much detail for this video because we want to save that for another tutorial, right? Net income CRUTs and CRUTs. So we'll talk about that in separate videos. But question 3, so both answers no there, right? We just have a standard CRUT, no net income kind of limitations. Did the trust change its method of payment during the year? No. Right, so we haven't changed the payment terms or when we make those payments to the beneficiary. The Unitrust fixed percentage that's paid to the recipient. So this is something we do start completing, right? So we have a 6% Unitrust payment percentage per the agreement. And then in line 4B, it asks us here, okay, so we want you to go back to the balance sheet. So go back to the balance sheet, Part 4, line 19, column C, so subtract the assets from the liabilities and multiply it by the percentage on 4A. So if we look at column C up here, we've got the total assets minus those liabilities, so $1 million minus no liabilities, and so the $1 million times 6% is going to give us a $60,000 Unitrust payment for the year. However, we got a short year return, right? So 4B calculated, as if it was a full year, but then we mark up here that this is going to be a short year return, and then we calculate the Unitrust distribution, the prorated amount, and we list that down on line 7. Now, why aren't we doing 5A through 6B? Well, notice here it's asking us, if you answer yes to any of these questions on line 1 or 2, right? So if you have a net income CRUT or if you have a net income CRUT with a makeup provision, you do have to fill out these fields because now it's more important. Now we need to know what's the trust accounting income for the year. Do we have any accumulated distribution deficiencies from previous years, right? Do we have any carryovers if we have a net income CRUT with a makeup provision? And then that will affect the Unitrust distribution for the current period. Doesn't apply to us, right? We just have a standard CRUT. All right, so questions 10 and 11 didn't change the method of accounting and valuing the assets. No additional contributions during the year. All right, so now into part 7, statements regarding activities. Question 1, are the requirements of IRC section 508E satisfied? So this is the limitations on self-dealing, right? So those issues that we have with private foundations. Same things apply to CRUTs. We have to be clear that we are not engaged in any kind of self-dealing. Very, very important. Otherwise, we're violating a lot of rules. Question 2, we are not using this to report income and assets of segregated amounts. Part 8 here, the 4720 for excise taxes. This is very, very important. Many times CRUTs or private foundations as well will find themselves in positions where they did something that triggered an excess tax. So they did have a self-dealing issue, right? So you have to answer all these questions, be very carefully look at each one. In most cases, if the CRUTs are doing everything by the book, the only time they're going to have a potential issue, but then they mean an exception for, is with trustee payments. So in question 1A4, it asks us, do we pay any compensation to or reimburse expenses of a disqualified person? Well, under these rules, the trustee, even if it's a third-party trustee, so not related to the contributor or the beneficiary, they are still a disqualified person. So most of the time we are answering question 1A4 yes, because we did pay compensation to a disqualified person. But then the exception applies generally under this regulation, right? So in question B, it asks if we answer yes to any of these lines, did any of the acts fail to qualify under the exceptions? And the answer is no, they did not fail to qualify because we paid this third-party trustee and the compensation was reasonable. All right. So then move on through the rest of the questions, answer them yes or no accordingly. Big things to look out for: excess business holdings, right? A lot of companies, a lot of private foundations and trusts will get in trouble there because they contribute closely held stock or things like that. No investments that jeopardize charitable purpose, right? Those are all okay. And so again, continue to just go on and down the list. Make sure you don't have any issues. The last one, also very, very important, right? So charitable remainder trust, those are 664 trusts. Do we have any unrelated business taxable income? So UBTI. If so, yeah, you got to pay, hefty tax on that. In our case, no. We just have publicly traded stocks and bonds, no excess business holdings, nothing, no interest in partnerships or other kind of pass-throughs. So everything was good there. Part 9. So part 9. Section A, all trusts have to answer this part. In this case, none of these apply to us, right? We didn't have any interest expire during or before the current year. We don't have a lead trust and we don't have a pooled income trust, so we've left sections B and C blank. Section D for CRTs, this does apply to us, right? So check this box if the CRAT or CRUT charitable interests involve only cemeteries or war veterans posts. Well, that's not us. I mean, we our charitable beneficiary is a medical group in Florida, so it wouldn't apply there. Not making any election with regard to property distribution, so we only distributed cash. We didn't have any property distribution, so this election just doesn't apply. Not making any elections with respect to CFCs for question 12 because we don't have any CFC interests. It is an initial return. So question 13, this is an initial return, so we are going to attach a copy of the trust agreement. No trust agreement amendments, not a final return. And then lastly, in question 16, we don't have any foreign bank accounts, so no FBARs are going to be filed. Okay, so Schedule A for the accumulation schedule and distributions. So this is a fun one. So this is where we have to complete this in order to accurately complete the K1 for the income beneficiary. So what's happening here? The accumulation schedule is showing the amount of income that is available for distribution to the income beneficiary during the year, and it is showing the character of the income broadly between ordinary income and capital gain. And then if we have any undistributed income at the end of the year, what's going to be the carryover, right? So the total distributable income here, this is asking us to pull the amount from Part 2, Line 3. So if I go all the way back up, Part 2, right? Remember, this is page 2 of the 5227. So we have our schedule of distributable income for the current period, right? So the total amount on line 3, so that is being reported in part 1 here. So we've got the total on lines 1, again in the accumulated NII section. So the ordinary income, the capital gain, the total unit trust distribution for the year, and then the the extent to which this distribution comes out of these baskets. So how do we determine what is going to be the character of this income across these baskets? Well, we look at the ordering rules again. So the ordering rules, remember, it's basically coming out of the highest amount of tax that could apply to the income first, right? So income is generally allocated based on using those highest tax rates for income. And so generally we're looking at this following order right here in the second bullet point. So we distribute out interest income, non-qualified dividends, right? Because those get no preferential tax rates, right? Those are just subject to ordinary income tax at the highest rate and NIT. Then we would move on to qualified dividend income, capital gains, collectibles, long-term capital gains, tax-free income, so again, that municipal bond interest income, and then lastly, we have return of principal or return of corpus, right? So the very last type of amount that could be distributed out is principal. All right, so we've got those two amounts there. We've got the distribution amount. So how do we complete these two sections here on lines 2B and then the rest of this Part 3 distribution schedule? Well, we go back to our basically the same schedule we use to allocate the deductions, right? So I try to do it all in one here. So the total distribution is $54,082, right? That's the prorated amount for the first short year. So when you think about this in ordering from what gets distributed first on the way down, the $54,082 comes out of the net interest income allocation, then it moves on to non-qualified, then it moves on to qualified, and then capital gains, and then corpus, right? So the $54,082 takes away all the $79.61 in interest. It takes away all the non-qualified dividend. It takes away all the qualified dividend. So it basically eliminates this entire ordinary income basket of $37,523, right? And so that's why if we look at the Part 1 schedule here, all $37,523 is being distributed out. And so we've also put that amount down here in column D for the amount that's distributed to Adam. That's all ordinary. So all the ordinary income has been distributed out, right, per the ordering rules and based on the amount of payout that was going to Adam. Then you move on to the other items, right? The only other item we have is short-term capital gains. So the capital gains and the ordinary, the total is $65,265 here. Well, we didn't distribute $65,000 and change to Adam. We did $54,000. So effectively, the $54,000, the difference between the $54,000 over the amount of ordinary, this is the difference that is remaining that was paid out to Adam. That is capital gain in character. So $16,559 in short-term capital gains was distributed to Adam. And so we put this $16,559 in the short-term section, and we've shown $16,559 was taken out of column B, which leaves a remaining amount, $11,183, that's carried over to next year and could potentially be distributed to Adam, right? So we've got the column D and E. We didn't have any long-term capital gains. We didn't have any non-taxable income, no corpus. So in column I, we add lines D through H. We got $54,082, all of which is net investment income. All right, we have all post 2012 income. It's all NIT. The other thing to remember, this simplified net investment income calculation, if you make, this is not by default apply, but you can make an election to where you have different ordering rules with respect to how you distribute out and allocate NIT. In this case, generally you don't see that. So in our case, it's kind of a moot issue. So we have not made this election. We're just doing the ordering rules, the initial ordering rules as they're laid out in the regulations and the form instructions. And then on line 4, it asks, look, if our total in column I does not agree with part 5, line 1B for a CRUT, or part 6, line 7 of 5227 for a CRUT, you got to check here and attach an explanation. What they're referencing there is the Unitrust distribution to the beneficiary for the year, right? So if we go back to part 5, line 6, the total Unitrust required distribution, line 7, $54,082. And so they're asking us, have you accounted for all of that payment? In other words, you paid out $54,082. Have you told us exactly how much of that is allocated to ordinary, short-term, long, non-taxable, and corpus? And in this case, we have, right? So the $54,082 is being allocated across these categories appropriately, and so we don't have to check here and attach an explanation. Now, current distributions in Part 4, as you can see here, it's asking for lead trusts or pooled income funds only. We have a charitable remainder trust, so we complete Section 664. Part 5, Question 1 is asking if this is an initial return where any assets contributed to the trust in 2022. Yes. Right, this is an initial trust return. It was funded this year, and so we list the information on the donor. So John Smith was the donor. He contributed cash to the trust, and the value of that cash was $1 million, contributed on February 5th, 2022. Question 5 for CRTs, if this is a final year, was an early termination agreement signed? Not applicable, right? This is an initial year, not a final year return. All right. Now, on to the K1, right? So the K1, again, very important to distribute this to the income beneficiary because they need to know if they received a payment of cash or property, to what extent is that income versus principal? And then, more importantly, if it is income, what is the character of the income being distributed to them? So if you think about this in kind of a quick check format, if we look at the income items here, remember Adam was paid about $54,000, and so if you add up all of these income categories here, the interest, the dividends, and the capital gain distributions, there's the amount of cash that he received during the year. So he can look at this and say, well, okay, I understand now. The $54,000 I received comprises net interest here, net dividend income, and short-term capital gains. And so these amounts we've pulled through from our workbook, right? So if we go back to our workbook here, we can see the net amount of interest being applied, $7,961. The qualified dividend income, $20,024. And if you add the two up, qualified and non-qualified, you get $29,562, right? That's the total dividends. The portion that's qualified is $20,024. And then we have that net short-term capital gain component of $16,559. So that's how those numbers end up there. The beneficiary statement here, obviously the trust EIN, name of the trust, list the fiduciary information, so who's the trustee, and then down here the information on the beneficiary, right? So Adam is a domestic beneficiary, so he's a U.S. person. We've got his name and address there, his social security number. And then, again, remember, there's no, the 5227 doesn't have its own version of the K1. So we just use Form 1041, Schedule K1, and that will suffice. That'll be appropriate as far as the filing with the IRS and what you provide to the beneficiary. All right, so that covers it for this tutorial. I hope that was helpful. If you have any questions, feel free to leave me a comment below. And of course, check out the other videos on the other 5227s that I'm going to put up. Those are on lead trust, CRUTs, net income CRUTs, and net income CRUTs with makeup provisions and the like. So thanks again, and I look forward to seeing you again on the next video. Bye.